My name is Katherine. I'm with APG Asset Management, which is a Dutch pension fund-owned asset manager with a 100-year-old history. We have over 650 billion of assets under management, of which 125 billion is invested in private markets. And I'm very proud to share that we were one of the founders of the co-investment market with the first transaction somewhat 23 years ago. And in the past decade, built a dedicated co-investment effort within our private equity team, which executed over 100 transactions during that period. And we are currently co-investing between 1 and 2 billion euro per year. That's the PE side. On the real asset side, our co-investment business went through a different evolution. For instance, within our infrastructure portfolio, the first co-investment transaction was executed 70 years ago, and today approximately 10% of our 24 billion infrastructure portfolio consists of co-investments where we invest alongside funds, but also alongside separately managed account. So being one of the first movers, it's great to see how the co-investment has evolved into a separate asset class and in a professional business it is today. And of course our teams evolved with it, just like many other organizations in this room. So I think the benefits of co-investments are undisputable. We are very active in the co-investments, and being a co-sponsor of many transactions, we never pay a fee and a carry, which makes the net returns, of course, much higher. And additionally, you get the opportunity to be selective in terms of transactions based on, the HG profile, impact requirements, etc. Of course, co-investment comes with various risks, which should be properly assessed and mitigated. In our dedicated team, just like any other LPs, have been managing those risks in the PE programs all the time. But the times are changing. A lot has happened in the recent years, which led to this environment of low growth, high inflation, and high interest rates. But what does this mean for co-investments? And how should LPs navigate through these market conditions? We're going to discuss this today with the panelists I'm going to introduce to you briefly. Next to me is Carole BARNAY. She's Senior Managing Director on the co-investment team at Ardian, a France-based private equity investment company, which is also one of the largest PE funds in Europe. Next to her is David Smith, a Senior Managing Director on the co-investment team at Capital Dynamics, which is the global asset management firm focusing on private markets and clean energy. David has various positions in the firm and over 30 years experience in PE. Then we have Kasper WICHMANN, who is currently taking some time off, but previously worked as a head of PE for UBS Asset Management and most recently built a PE offering for a Danish asset manager. He's also author of his blog about private equity called PE Compass. And then last but not least, Mateusz MILEWSKI, Director of Private Equity at PZU, one of the largest financial institutions in Poland and Central Eastern Europe with a 200-year-old history, even older than APG. So as you see, we have a very diverse team today at the stage. First, of course, in terms of mindset and background, and secondly, of course, in terms of gender. And I think, 10, 20 years ago, this would have been different, so it's great to see that. So, managing co-investment portfolio in challenging times. Carole, can we start talking about the risks associated with co-investments, and second, the consequences of this current market uncertainties on those risks? What is your take on this, and what do you see on the deal side?
Sure, Catherine. So happy to see all of you. So when we speak about co-investments, we have to distinguish when thinking about risk between the co-investments that are done by the LPs themselves on a case-by-case basis and the co-investments that are done by dedicated co-investment teams that are building portfolio product that will be balanced and diversified and that will have not at all the same risk profile. So when we speak about co-investment, the inherent risk to co-investment is of course the fact that you are a non-controlling shareholder. It means you will have less visibility on the company at the time you enter, and it means that if things go wrong, then you won't have the same room of maneuver. So it implies that the go, no-go decision is even more critical than if you are a majority buyout fund. And it implies that you have to, it's really demanding in terms of expertise, and you will have to put an additional layer of due diligence above all the ones that we usually have, that is the GP assessment. So finally, the risk management with co-investment is also has to be seen with the very important point to be totally aligned in terms of interest with your GP and to be pari passu when you do the deal. So the risk in the current context is, I see it in two ways. The first one is the price. Of course, that's obvious. Many transactions today still have not adjusted their valuation. This is what we've seen during the global financial crisis. It takes time. It takes more time than in the listed market. So this is a clear risk and a clear reason to decline today. The second risk is the nature of the deal flow that has evolved in the sense that usually you've got poor, medium, and good quality assets. Today we really see a very deep gap breakdown between a few high-quality assets and all the rest of the deal flow that is a mix of good and poor quality assets. I will revert back on the high-quality assets because that's what interests us, all of us, I think. But on the poor, medium quality deal flow, those companies won't be able to return the same performance and deliver the same growth that they did over the past 4 or 5 years. So definitely we cannot, with those deals, even at fair price, target the same returns that the one they've delivered over the past 5 years. So it implies for us, in terms of risk, that we have to really focus on a very narrow segment of high-quality deals when we are a co-investor.
Thank you, Carole. David, do you agree with Carole? Does the co-investment strategy make sense in this under these market conditions?
I think yes, it does, and nice to see everybody. Welcome. I think Carole covered the co-investment piece, as it were, very, very well. If we think about what co-investment is, firstly, it's direct investment. So everything that impinges on direct investment in terms of risk also impinges on co-investment. So therefore, there are some profound similarities between co-investment as a discipline and direct investment as a discipline. Before I go on, how many GPs in the room? Just raise your hand so I can sort of tweak the answer slightly. And LPs? Okay, so balance, great. So I'll try and respond with that in mind. The three profound differences are as follows. A co-investment fund is unique in one respect compared with a regular direct private equity fund. Of course, direct private equity funds, those of you who raised your hand first, diversify their portfolios generally by vintage, sector and country, particularly if they have a global mandate. And of course, Carole's business and my business does that as well. But one of the great advantages of co-investment is you have a fourth leg of diversification, and that's manager diversification. So when you build a portfolio of co-investments, one of the important differences is the manager diversification. We're quite quanti in our organization. I think Carole's is as well. And we can assess that manager diversification by its impact on the spread of outcomes in co-investment. And what you find is if you diversify a co-investment portfolio properly by manager, it has quite a profound impact on the spread of outcomes, the spread of risk that you see. So the first difference is portfolio construction. We call it intelligent portfolio construction in our organization. The second, particularly for the GPs in the room, is a natural consequence of there being three parties involved, not two parties involved in a co-investment. You've got the issuer, you've got the lead investor, and you've got the co-investor. So those of you who have attended other sessions over the last day or so would have heard the word alignment a lot. It's really important to maintain alignment. So things like tag-along rights, drag-along rights, preemption rights, exit rights, and so on, they should be pari passu with those of the lead investor. Otherwise, you can end up in a bit of a pickle. I think most of us in this business have learned that one the hard way. Certainly I have. And the last one is, in addition to portfolio construction as a diversifier and a way of reducing risk, what some co-investment organizations do, ours being an example, is you can use structure as well to diversify. So if a GP, one of you who raised their hands a moment or two ago, comes to us and says, we want you to put 40 million in the common equity, ordinary shares of business X, if we look at that business and say, I would rather be in the preference shares, preferred stock for those of you from the US, with a warrant, we will do a transaction like that, particularly in more challenging times. And the reason we do that is that it insulates us from downside risk in more choppy markets.
So the co-investment strategy makes sense. There are, of course, risks. Carole, back to you. How can LPs manage those risks? What are you seeing in practice?
Yes. So those risks, you manage them in two ways, actually: the deal flow and the way you do diligence. When you are a professional co-investor, what is important to build that diversified portfolio that will be intelligent in terms of risk adjustment, returns. The deal flow will need to capture two very important criteria that are quantity and quality. Quantity, why? Because you need a large base of GPs just to be sure that you have a significant amount of opportunities to maintain a very strict selectivity ratio. So just taking the example of Ardian, annually we see about 300 opportunities, and we have today a 3% selectivity ratio, meaning we only do 3 deals out of 300. But quantity is not at all enough, because you can have many poor opportunities and it won't make the performance of your portfolio, of course. So you need quality, and quality is challenging because you need to have exposure to a large panel of top GPs that are top quartile to ensure that you'll get the choice really among the most attractive buyout deals. And not only you need the top quartile GPs, but you also need diversified GPs, because you need to balance your risk in terms of geographies, in terms of sector exposure. So you need GPs that are strong in healthcare, in tech, in retail, etc. And you need also GPs that are diversified in terms of size of companies, targeting large cap and small cap companies with a good balance between the two extremes, so that you also balance your risk in terms of deal size profile. So this is quite challenging platform to build. It doesn't take one day to do it. So within Ardian, for example, we've built that platform over the past 20 years. And the second criteria, that is the due diligence, and I'm reverting back on the notion of high quality asset. When you do a deal, you have to match without missing one, all those 3 criteria. The one will be, especially today, the industry that will be recession resilient. It means that you need to target business and industries that will be non-discretionary spending businesses. You need to target companies that are a business model that is recurring and a sticky customer base. And ideally, you absolutely need a leading company, because it will mean that you will have the strong management team and you will probably be able to take market shares in difficult market environments. Inversely, if you're not looking at the leader, then you have to go with a small company that will be disrupting the market. So you really need to match all those criteria to be qualified for a high-quality asset that will secure your portfolio return.
David, do you share this view? And also, do you see investors adapting their co-investment strategies to handle these riskier market conditions?
Yeah, I think in general I would agree with what Carole has said. I think if I were to sort of pick a couple of points from that quite comprehensive sort of tour around what we're seeing at the moment, I would pick the, in terms of the deals themselves, the important thing is if we're looking at a recessionary environment, which I think most of us think we're facing, depends a little bit where you are in the world, but let's assume that's a broad yes for the moment. Picking recession-resistant businesses is obviously key. So you've got sectors which are generally recession-resistant. I won't name them. Many of us know what they are. And then occasionally you'll find something that is so mission-critical to an organization that come rain or shine, it's about the last thing they'll turn off. So, I mean, think about e-billing, for example. If you're an electricity or a gas utility and you need to bill your customers and you do that with digital billing, you're not going to turn that off, are you? So it's just something that springs to mind. I think the other thing, I touched on it earlier, I think adapting your strategy to a more difficult time where you want to play in the right part of the capital structure. I won't repeat what I said earlier because I think you heard it. But just think carefully about, you know, do I want to be in the ordinary shares? Do I want to be in the pref? Do I want to be in the mezzanine? And of course, if I want a private equity return, I'm going to need some warrants or some, you know, some kind of equity kicker, as we used to call it in the old days. So I think those things are important. So be agile, fundamentally, and adapt
always,
to market conditions. Yeah.
Thank you. Kasper, let me move to you. So there has been a significant interest in co-investing in recent years, but not everyone has the scale, skills, and of course resources to successfully execute a co-investment program. So they consider outsourcing as a strategy, which comes with benefits, but of course with many risks. So what are, according to you, the pros and cons of outsourcing? And once you decide to outsource, what do you need to look for in a manager?
Great question. Everybody's been really busy doing co-investments in recent years, mainly driven by, well, we can average down on our fees. I think that's part and parcel of why you should do it, but it isn't the raison d'etre to do it, I think. I'm a firm believer that most LPs should outsource to some of the people sitting on my right. I'd widely recommend it. Pros of outsourcing: simplicity. This is a very risky business. It's very resource intensive. There's less risk on your books if you do it this way. There's economies of scale that we simply don't have as normal LPs versus specialized players. You get a better risk-adjusted return overall. It may look like you got 2x, and 2x on an absolute level may have been sufficient for your reporting, but what kind of risk did you take on board? I think the last 10, 15 years, we didn't think too much about that. Then there's the operational challenges of handling co-investments. We saw it in Q1 2020. All of a sudden, we had to do equity cures. We haven't done equity cures for 10 years. Now you have to go back to your board, and your board might not be very savvy, and so, but we just put equity in. Why are we putting more in? So those are some of the pros, I think. On the con side, I'd say one of the biggest things for me is you lose an ability to fine-tune your portfolio on a sector, on a vintage. So you lose that ability, which can actually bring something extra, maybe even some J-curve mitigation. There's obviously an extra element of cost. Here I'd encourage LPs to think about, yes, there's extra cost, but there's also cost internally of running the program. I think we're susceptible to forgetting that it's very expensive to run these programs. You need good people, you need to retain them. And then there's not developing in-house expertise, which if you're growing a program is something worth considering. But again, maybe you want to piggyback on people who've done this for 10, 20, 30 years and learn a little bit from them.
Thank you, Mateusz. You're currently in the process of building a PE program and also considering outsourcing. So do you agree with pros and cons Kasper mentioned? And also, what is important for you as LP? What do you look for in a manager?
Welcome, everyone. So first of all, I do agree with Kasper. I share the same view. It's mostly about the scarcity of the sources we do have mostly as an LP. It's very popular to say as an LP that we like to do co-investments, but to be honest, when there's a time to do that, not everyone is well prepared to do it. What I would recommend, and how do we see that, you have to answer the first question: what's the purpose for you? Do you like to make, to teach your organization and to save that skills in-house, or it's right about the way of diversification, just for the pure performance reasons? Co-investments are really at the top of the agenda for many LPs. If you could just derive from the data from World Economic Forum in 2012, it was around 24% LPs who used co-investments. In 2021, it's like 70 plus. The outcome, I think we talked about it with Kasper, is not always a great one. It's all about the scale, the program which you have in your organization. Like we do have like 20, 30 plus relationships with GPs. Organizations like our friends here has, they are exposed to much more GPs, and they have much more opportunities to check, to dig in, to choose the best ones. So I would strongly recommend being and entering into co-investments area LP to do it wisely and do it step by step, not to rush too much. And that's, I think, on our agenda to do it that way. When it comes to the way how do we choose who to cooperate with, I would say that's very much similar to the process of looking for a good GP. There are many things which are really you are checking it on the same the same places, the same you look for the same thing. So there are not too many. I would say there are a couple of good players on this market, but there are just very few, very specialized in it, who are in the market doing the same strategy for many years. So that would be my answer.
And have you also considered insourcing, building out your internal team?
That's still to be discussed, but I think I said a lot, and I shared that at this very momentum, I would say it might be interesting to cooperate with someone who's just dedicated to co-investment and try to share their views, their best practices, to put that in-house. But it's a different business, and if you would like to do that just in-house from scratch, that might be challenging for middle-sized, let's say, LP.
I think it's just challenging for many organizations. And Kasper, so once an LP decides to build out a dedicated team, what skills does the team need to have in general, but especially in this environment we are discussing today here?
Well, I think Carole already alluded to it. They need to be able to generate sufficient deal flow. That's obviously helpful if you have a big primary program, but you need to have the deal flow to offset some of the risk, and then you need due diligence skills. So you probably need to go out and hire people and retain people that could be working in a direct fund. And here you have to think about, does your organization allow for these types of things? You need domain expertise if you're looking at particular sectors. You need to go beyond, well, I trust my GP, so I'm going to do a co-investment, because GPs build portfolios and some companies don't make it, and that's the one you don't want to be in. You need to be able to move fast, you need agility, you need a large capital base to back it, because that's what the GPs are looking for. Can you move fast? Are you agile? Are you flexible? And can you actually write a big check? Maybe you syndicate it later on, but that's fine. And you need to be able to move fast, and that's again something I think a lot of very institutionalized LPs forget. We need good governance and good processes. but we cannot just have a board meeting once a month or once a quarter, because by then the deal will have passed. Even the syndicate will have passed at this point in time.
So my panel today is in favor of outsourcing. Does anyone have a different view of this, or perhaps a question? Everyone is in favor of outsourcing, except for APG. Let's see, we have just a few minutes to go before the lunch. Final thoughts. So my last question to all of you is, what does your crystal ball say about what is going to happen within the next few years, and how can LPs, but also GPs here in the audience, benefit from it? Carole.
Yeah, so what we see currently is definitely the fact that the co-investment market has significantly enlarged for people like David or I, because there are many LPs that have stopped investing simply because the environment is too risky for them. So that's great for us, because the market has enlarged, so we can even raise our selectivity ratio, and we can reinforce or build new GP relationships. So the question of whether the deal flow is more challenging and what will impact does it can have for our co-investment practices, I think definitely we can sustain the same types of returns that we have delivered over the past. Why? Because as far as you have the deal flow, quality, quantity, then it's not difficult to pick the best opportunities. And as I said, I'm sure that there are companies that will continue to deliver very strong returns. So you just don't need to go with the others. And in terms of ability to exit your portfolio, there are definitely companies that will have to wait 1 or 2 years more to deliver the returns in absolute value that was targeted initially, because the valuations are not anymore the same in terms of multiples. But all in, I would say that the vintages that are currently investing will probably deliver very good returns as far as you go with an experienced team that knows how to deal with the current environment.
Thank you, David.
So I'll make two sort of goes at the crystal ball, one at 80,000 feet and one at 80 feet maybe. So the 80,000 feet crystal ball gaze would be, I think, agreement with Mateusz's comments about the growth of co-investment as an asset class. When I started doing this in the early 90s, I would go out to dinner with people and they say, "What did you do?" And I said, "I'm a co-investment fund manager." And their eyes would sort of roll and go, "Huh?" We all know that's changed. So I think the growth that we've seen since the early 90s that Mateusz mentioned, I think will continue for all good reasons. The risk-adjusted return that Kasper mentioned. So that's 80,000 feet. 80 feet, one of my predictions for 2023 would be a higher number of co-investment fulfilled buy and build transactions in portfolios of general partners, where companies are growing, general partners perhaps are coming up to single risk exposure criterion in their own fund documentation. When we've had prior situations like the one we're facing now, we see asset prices falling, the secondary market and the discounts that we're seeing in secondary market widening is a really good indicator of what we'll see in co-investment probably 3 to 4 months later. We're in fact already seeing those EBITDA multiples fall. So a wonderful time to be doing buy and build in the portfolios. And of course, many GPs will want to be careful about their remaining capital, to stave off difficulty in other parts of their portfolio. So a lovely time when co-investment can come in, facilitate a buy and build transaction at an accretive multiple for everybody's benefit.
Well, I'm a credit analyst at heart, so I might be a little bit too negative, but I worry about all the dead bodies that are out there, co-investments that have been done in too frothy an environment. I think we've all been a little bit giddy, especially maybe after we got let out after lockdowns. So I think special situations are going to be picking up a lot of tabs for the people who haven't done their homework and invested in companies that maybe wasn't as solid as what we should all be looking for, and with GPs that maybe shouldn't have been funded, or at least maybe not funded by us. So lots of special opportunities out there, I think, coming our way.
From the LP perspective, my guess would be that there will be a couple of things going on. The cycles between the next generation will come back to the, let's say, regular pace. That's my view. The second is that the secondary market will be really booming. I think that there will be a lot of transactions there, so it will be very hard to to choose the not to to get across dead bodies in the in the wardrobe. So it's going to be very challenging. And I think that for GPs it might be a bit more challenging to fundraise. So being cautious of your capital resources, that would be something which should be at the top of agenda for many GPs.
Well, sounds like we're going to face a very interesting times with lots of opportunities, but also with challenges. So good luck with those. Thanks for sharing your thoughts today, and thanks for listening to us, and enjoy your lunch.